Welcome to topic 2, business structures part 4. So in the part 4 video, we're going to have a look at the various financial statements across our 3 different types of business structures. So in our comparison, we'll have a look at the aspects of the financial statements that are shared by all of our structures, and then we'll have a look singularly at the sole traders, the partnership, and the company's financial statements. And then we'll do a comparison at the end between public and private companies. So firstly, aspects that are shared by all. So starting off with our income statement. The income statement for all 3 types of business structures are going to show revenues less expenses because they show a profit figure. So, and as we know, profit is derived from revenue and expenses. So it doesn't matter what type of structure we're working with here, we're going to see those 2 items on that statement. The format, though, may vary across the type of business in terms of if it's a service firm, a selling firm, or a manufacturing firm. But the format is not dependent upon the business structure itself. The difference comes in with income tax. As we know, sole traders and partnerships do not pay income tax. It's the owners of these types of businesses that pay that tax on their own personal individual income tax return. Companies, however, do pay income tax. So on the income statement of for a company, you will see a line income tax expense. With balance sheets, so as we know, our balance sheet shows our assets equals liabilities plus owner's equity, and it can get arranged to owner's equity equals assets minus liabilities. And those 3 items appear on our balance sheet regardless of the business structure that we're working with. The difference comes in the owner's equity section, as we do have different types of equity accounts depending on the business structure that we're working with. So you'll see that as we get into the video. Looking firstly at our sole traders' financial statements. As I've said, you should not see any income tax on the income statement of a sole trader because the sole trader business does not pay income tax. On the balance sheet, they only have 1 capital account. So we've only got 1 owner, so we should only have 1 capital account. If the firm has a drawings account, then that drawings account is actually transferred to capital at period end. So it's actually displayed as a separate account. Profit or loss is added. Or if it's a loss, it's subtracted to or from the capital account, okay, which we've seen in previous videos. So looking at the income statement for GG Coffee, sole trader, you can see we've got revenues, less operating expenses equals profit. Okay, so as a service firm there, so it's a nice simple income statement that we're looking at. Look at their balance sheet, you can see we've got assets, liabilities, then we come to net assets, which is assets minus liabilities. Then we look to the owner's equity section where you can see we've got our 1 capital account and profits in there as well. Also note on the balance sheet that assets minus liabilities equals total equity. Okay, so our accounting equation is standing true. So just wanted to slip that one in there to show you just how important that accounting equation still is because you need to be very familiar with it for the next few topics. Looking at our partnerships, financial statements now. So same with the sole trader, no income tax should be appearing on the income statement. Owner's equity though is going to look a little bit different because we're going to have a capital account and a current account for each partner. So we'll have multiple, okay, multiple capital accounts, multiple current accounts. So with the current account, all that current account is what it captures is it captures the drawings and also the partner's share of profit or loss that might occur during a period. So the capital account for partnerships tends to be that initial capital contribution, and the current account is more capturing the movements in the owner's equity, okay, from profits and drawings. Profit or loss, it's split according to the partnership agreement, as we know. Or if there is no partnership agreement, then that profit or that loss is going to be split equally across our partners. So looking at our income statement now, still taking a really similar form to a sole trader. So we have our revenues minus our expenses, gives us net profit. But then you can see the extra section down the bottom there, okay, just here, where we have our distribution to partners. So each partner is getting a salary, and then they're getting a distribution of the remaining profit. Okay, and if you look at the very bottom, you can see we have 15,600 was distributed, and that matches that net profit figure as well of 15,600. So they're showing that here's the profit we made, here's how we've allocated it or distributed it to each of our partners. Looking at the balance sheet, again, you can see assets, liabilities, equity, but look a bit closer at the equity section. Looks different to the sole trader, and that you've got multiple capital accounts, multiple current accounts. Okay, so we've got 3 of each because we have 3 partners in this example. And again, also note net assets does equal equity. Looking now to company financial statements. So for company's income statement, then you should be seeing income tax. Okay, and that income tax is taken directly from the company's profit. So it's a special line item on its own. It tends to appear further down the income statement. But if you're looking at a company's income statement, you should definitely see a line there for income tax. The owner's equity section of the balance sheet is going to look different again from your sole trader and your partnership. This time we have 3 types of equity accounts. We have share capital, we have retained earnings, and we have reserves here. So that's one way also to identify that you are looking at a company's balance sheet, is look straight to the equity section. Can you see 3 different types of equity accounts? Yes, company balance sheet. Okay, so you'll see these accounts instead of the owner's or the partner's capital accounts. So we just have a little bit of a closer look at these 3 types of accounts. So share capital, what is it? It's the total value of the shares that the company has issued, okay, that the owners, okay, or investors have purchased in the firm. Then we have retained earnings. So retained earnings, so that's the profits that the company has chosen to retain within the company rather than distribute out as dividends to its shareholders. And then lastly, we have the reserves account. Okay, so for this course, you don't need to know a lot about reserves account, what they are, how they operate. All you need to know is that they appear in the owner's equity section of a company balance sheet. Okay, that's as far as your knowledge needs to go. So looking now to a company income statement, and you can see there circled in the red, taxation expense 30%. And note also with profit that profit's displayed before tax and profit is also displayed after tax as well. Okay. The balance sheet, in general, it looks similar to our sole trader and also our partnership in that we start off with assets, less liabilities, and we come to net assets. Then we hit shareholders' equity. So slight difference in the names here. And note that we have share capital, we have general reserve, and we have retained earnings. Okay, but also note our accounting equation, it's still standing true in this statement as well. Okay, our net assets, 148,550 equals total shareholders' equity, 148,550. Okay, so we have similarities between the statements of our business structures. We have differences as well, and also note the accounting equation every time in the balance sheet, regardless of structure, it is also standing true as well, which is what we want to see, which is awesome. Okay, it has to come through. It's the root of all accounting. So if we now do a comparative for our public and our private companies. So all companies or corporations, we can call them as well, regardless of the type of company they are, they do have to comply with the Corporations Law or the Corporations Act. So some companies, generally our smaller private companies, they don't have to comply with accounting standards. Okay, so the Pascal on the previous slides, where we saw the example of their financial statements, he wouldn't have to comply with accounting standards. Okay, smaller companies don't really have to because there's not really a lot of there's not generally a lot of users of their financial statements. Most public companies though have to comply. It's mandatory, and they have to prepare financial statements that are consistent with those accounting standards. So say we've got JB Hi-Fi. So if we look at the differences between JB Hi-Fi, big corporation, and Pascal, small sole trader, we can see that JB Hi-Fi's accounts show consolidated figures, and they also show summary figures, which we'll come to shortly. And also, as a public company, JB is complying with accounting standards, and also what they have to include is notes to their accounts and comparative figures. So really different, or a really different set of requirements around JB Hi-Fi and what they're reporting, as opposed to Pascal, the sole trader, who really doesn't have to do a lot. Okay, so here's JB Hi-Fi's income statement. So you can see there, they've got their revenue, their income, subtracting off their expenses. So their expenses look a little bit different because they present summary figures. So they have sales and marketing, occupancy, administrative, finance expenses. So they're actually groups. Okay, and you can see on the side there, you've got consolidated. So JB Hi-Fi does ultimately comprise of a number of companies, so a big group. It owns multiple other companies. So that's what they're presenting here, not just JB Hi-Fi on its own, but their entire group of companies that are owned by JB Hi-Fi. Okay. So their income statement is looking a little bit more complex. If you look at their balance sheet, we've just narrowed it down just to the equity section because that's really the part that's completely different, say, to Pascal, our sole trader. So you can see JB Hi-Fi in the equity section, they've got their issued capital, they have their reserves, and they have their retained earnings. Okay, so we've got those three different types of equity accounts coming through here. So just to summarise where we're at, or actually no, we'll be summarising topic 2. So each of the financial statements reflects the business's financial position and financial performance separately from those of the owner. And it's critical that they are kept completely separate, okay, except for where you have got overlap. So you've got owners that are buying shares in the company, or you've got a sole trader who is investing more capital into their business. In those cases, yes, because there's a transaction involved that does directly affect the business. But when it's the owner's personal funds and they're buying something, say, for their house, then no, that doesn't go anywhere near the business's books. We keep it completely separately. The main differences in our financial statements and between our businesses or our business structures occur in the distribution of profits to our respective owners, okay, as you've seen looking at those different equity sections. So this in turn is going to have taxation implications. Now if we just have a quick look here, just summarising the different accounts between the different business structures. So you can see with the sole trader, one capital account, one drawings account. Partnerships, in this case, we're assuming we have 2 partners, but if you had 3 partners, 4 partners, obviously the accounts here would multiply. So multiple capital accounts, multiple drawings accounts, and multiple current accounts. So you need one for each of the partners that you've got here. And then for our company structure, we have our 3 types of equity accounts. So we have our share capital account, so that includes our issued and our paid up capital. We have our various reserve accounts, and then we have our retained earnings account here for a company structure. So that really concludes topic 2. There is still one more video, part 5, and in that video we have a few practical examples where we're going to go through and calculate some equity figures. Okay, so I'll see you in the next video.